If I'm looking at you right now and you have a startup today, can you double or triple your value this year? And then can you double or triple your revenue again the following year? So it can grow between 4 to 9 times in the next 2 years. That's how that people will be thinking about it from a more quantitative point of view.
Welcome to Brave. Learn from Southeast Asia's best tech leaders. Build the future, learn from our past, and stay human in between. No BS on success. I'm Jeremy Au, venture capitalist, serial founder, Harvard MBA, science fiction nerd, and dad of 2 daughters. Every week, we debate startup news, interview changemakers, answer listener questions, and share personal insights. Join our movement of over 40,000 members and get transcripts, resources, and community at www.bravesea.com. Stay well and stay brave.
So what we have here is that VCs are looking for founders that will create a billion-dollar company in 10 years. And so people forget that what people look like 10 years ago is very different. So 10 years ago, I was building my small thing. A lot of people look at Jeremy and say, this is a nobody, whoever it is. But I had wonderful mentors and wonderful people who looked at me and said, this is who Jeremy can be at the age of 37. Because when I was 30 years old, I only had Google, I only had books, I didn't have ChatGPT, I didn't have all these tools, and there was very little technology frameworks and understanding to support me. So at that time, when I was 30 years old, lean startup was relatively new. A lot of these things were new. So I mentor somebody who's a fresh grad, and he's doing really well. He graduated also from NUS and graduated around 25 years old. But yeah, I look at him and I'm like, yeah, this guy is way better than me in the profession of venture capital than I ever was at 25. Because venture capital as a job didn't exist in Southeast Asia when I was 25 years old. But again, it's really about potential. Can you identify people that are going to be fantastic? And obviously, you're going to pick people who look cute and turn out they cannot be a unicorn. And then you also identify people who look cute but actually do become a unicorn. And a more transactional or financial way of looking at this is, if I'm looking at you right now and you have a startup today, can you double or triple your value this year? And then can you double or triple your revenue again the following year? So it can grow between 4 to 9 times in the next 2 years. That's how that people will be thinking about it from a more quantitative point of view. And so VCs have to assess the founders, then they have to assess the strategy that they go after, and then they go and look at the pitch deck. And the pitch deck is a way to introduce the founders and the strategy when we are strangers. We don't know each other yet. You send me a pitch deck. So I got a WhatsApp message. This person's a doctor. He's sent me a message several times now over WhatsApp. And he's, hey, Jeremy, can we get a coffee? And I'm like, I just don't have time. I'm busy teaching here. I'm doing this and doing that. And so he's, hey, Jeremy, can I send you a pitch deck? And I don't know who he is. So I'm looking forward to see his pitch deck, and I will find out who he is and whether I want to get coffee with him, right? Because if not, I have other things to do, right? And VCs are judging based on 3 major aspects: a 10x team, a 10x product, and 10x economics. So a 10x team is saying, is this team 10x better than everybody else? A rock star team that has the hunger, the drive, the humility. A 10x product, is this product make sense? Is it solving a problem that is really painful? And 10x economics, is this something that's going to be able to preserve that monopoly power, the ability to maintain pricing and profit for a period of time? And for us, as a unicorn, if you're a very early stage investor, angel investor, I've invested in a founder, everybody wrote him off for dead, basically, because his first company failed. I was doing a bit of coaching and support. Everybody wrote him off. All his previous investors wouldn't invest in him again. And I just sat down with him, etc., etc. And then I can tell you right now that fast forward a year on, he's gotten a lot better, a lot stronger, and now he's recently on his way to successfully raise $20 million of venture capital, right? So imagine like, well, 1 year, company failed, nobody wants to hang out with me. Him, Jeremy, hangs out with him. Fast forward now, by the end of this year, he will have a company that's worth $25 million valuation, right? So things can change very quickly, but obviously when you're early stage, you're obviously looking at the earliest investment. And then obviously in terms of the product, when I underwrote him, he was at a team. Then he had for a product, but now the product has gone well. So now he's going to go for a $25 million valuation. And then I hope that he'll be able to become a $100 million, a billion-dollar company. All right, and this guy is also relatively young as well. As a result, I have a decision tree, everybody's decision tree. A lot of it's intuitive, obviously. I meet you, do I want to meet you again? Obviously, there's a more logical way, and I think this is a helpful way for folks to be thinking about the fact that there is a relatively structured process that VCs are looking at. And as a result, we talk about how heuristics are great. VCs are making very quick decisions, who to spend time with, who not to spend time with. The average pitch deck is only looked for 3 minutes at a pitch deck. So when a person sends me a pitch deck, I'm going to look at it on WhatsApp, and I'm going to spend about 3 minutes scanning through it. And obviously, I'm going to make some judgments based on that, and I could be wrong. And so it's very important for me to not, in my time compression dealing with different items, I need to be thoughtful about the risks. But again, pitching is a way to articulate the business logic. And if you say something that's illogical, everyone will understand it's illogical, right? So I was meeting with a company today. They are relatively, I say, entering the growth stage. And what's interesting was that this person was explaining certain aspects about the exponential model. And I was thinking to myself, like, this actually had been proposed to me 3 years ago. Everything they're doing today was proposed by another founder several years ago, right? And so both of them arrived at the same type of business logic about how the company should grow. It's just that one was able to execute and get it done, and the other person did not execute and get it done, right? But the logic of it was sound. As people will reinvent the logic over and over again, because if it's a good idea, it will come to life. If it's a bad idea, it will come to life and then it will get killed by everybody. So there is a Darwinian approach to good ideas. And so when you pitch, you need to be thinking about yourself, how do I prove it? How do I get stuff done? There's no point having a good pitch. Results are really the key thing. So if you deliver results, everybody pay attention to you. The second, of course, is building trust about who you are. And lastly, of course, is putting together a pitch deck that all of you will be presenting. And we talk about how trust is a system, and I really hope that all of you will be able to graduate and be thinking about your credibility, your reliability, your intimacy, as well as your self-orientation, and using that as a formula to build rapport with your teammates, as well as your supervisor, as well as with society. Everybody should be thinking about your capital stack, which is raising money from customers first. Then there's a lot of capital that's available, and venture capital is the most version of this. Because when I put in $1 million, I own 20% of your company for life, right? And that's a big chunk of your profits in perpetuity. So it's actually very expensive. But of course, in return for that, I am taking on the most amount of risk. So I'm willing to do that deal because nobody wants you, nobody likes you. The banks won't give you money, or they require a personal guarantee. So I'll reward myself with a high reward because I give myself the domain of working in a high risk area. Obviously, you want to hire the best investors and then structure an auction where there are multiple VCs that are competing to be on your term sheet. And so we talked about how there are two examples. One in 2018, Bench, which is the AI for lab operations, was able to get 5 term sheets in 3 weeks. So imagine before that, the founder is in a weak position. They are asking VCs for money. And then suddenly, if you are a company that has built the right idea at the right time with the right team, then the other way around, all the VCs are fighting to be on your company cap table, right? And then we talk about how Rewind AI is the most extreme version of that, where they receive 170 term sheets and they end up giving a Google document to say, hey, please submit your bid via Google Docs. So great founders get to pick, obviously looking for people who have personal chemistry, speed, high experience. And then after that, we talk about the 10 slides that all of you are writing, the cover slide, the market problem, the market opportunity, your solution, the team, traction, competition, revenue, acquisition model, and how much money you're asking for. And what we talked about is that one, you want to make sure that it's clear what the problem is. Make sure you explain why people are not solving this problem. Is that Jeremy's number one problem? Maybe it is, I feel, if people are not paying attention, maybe. But I think that could be my number one problem at this point of time. But of course, you also need to explain why has it not been solved, right? So that when you understand the problem, then you can understand the number one problem that people have. Now, obviously, based on a problem that you have that is really engaging and true, then obviously it's understood how big the total addressable market is, right? So, for example, we talked about friend.com, which is AI companion. So their pitch or replica says, everybody is lonely, okay? So their pitch is, everybody in this world is lonely and everybody will pay $10 a month to not feel lonely, to have somebody who accepts them for truly who they are. And they don't need to go dates, they don't need to go find a boyfriend or girlfriend, they don't need to have a husband or wife to be accepted, they don't need a therapist. Everybody feels lonely, so 5 billion people around the world all paying a month equals to 5 billion AI companions running as your best friend. So that would be the total addressable market that somebody could claim to obviously to build. Then obviously we talk about your solutions and demo, right? Show, don't tell in general. And you want to show the customer journey about how the person experiences it, but also why the experience is 10x better, 10x faster, 10x cheaper. And of course, you'll be building a team slide that is based on the current team that is actually building it, the leadership team, the startup they're doing. Obviously use photos, explain why they're good, explain why they're legit. And now obviously talk about the performance, the milestones obviously. Some of it will have public revenue numbers, you can share that. Some of them may not, but then you can show the awards or the soft milestones that they have about how they're growing and why they're amazing. And then of course, you then will want to show your competition. Every startup is competition, direct and indirect. And so this is normally shown as a 2x2 to show what it is. And what I challenge you to think about a little bit here is that at least one of the axes should be better or faster or cheaper, right? So a toothbrush, we talked about it in the past, is it better? No, it makes your teeth as clean as a normal toothbrush. But is it faster? It's because it's more convenient from perception, right? It's definitely not cheaper, it's more expensive, right? So we need to be thinking about the axes of competition. So the best products, as we saw from like SpaceX and Starlink, is that they actually outperform on two axes, right? It's both better and cheaper, for example, or it could be so on and so forth. But these are different ways for you to think about, and I'm happy to help you folks in those things as well. Then we want to talk about having a slide for revenue. You want to be able to very clearly explain, okay, this is how we make money. For every 100 clients, we charge them X amount of money, and they normally stay for 10 years, and therefore they don't churn that much. Have a high profitability, which means a certain customer lifetime value. So we want to make sure that we understand the revenue, how you make money from these customers. Then you want to talk about the financials, right? Which is what is the cost, what are the ways that you activate them, sell them, buy them, market to them, and what is the customer acquisition cost from your estimate as a team, roughly what that is. And then as a result, generate what the estimated lifetime value to customer acquisition cost ratio is. And then of course, the last slide that you have is that you want to ask them and say, hey, how much money do I want to have? So if you look at the pitch deck samples that we have, some of them will say, I want to ask for $10 million, right? For a certain amount of raise and so forth. So these are the ways that you want to talk about how you're going to use this money and what you're going to build as a result of that.
Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.